All right, we are connected for the Thursday edition of the news update. And as always, looking forward to connecting and sharing my 2 cents on a variety of subject matter. And it looks like the liquidity crunch is starting to rear its head above the surface, and private credit markets might be impacted, on top of lots of other entities that are labeled as investment firms, hedge funds, you name it. Anybody operating in this current debt-based Ponzi system that has future promises to pay might be on the hook. So we go talk about that and a lot more. But as always, welcome. Looking forward to connecting. It's been a minute since I've done a live stream. Lots of things I'm trying to juggle on the back end on my end. So I definitely am excited to connect and will try my best to connect more often. But before I move forward, for those who are plugged in, whether you're watching it live or watching a replay, let me know what you're keeping your eyes on. There's dozens, if not hundreds, of topics, but I'm focused more so on the monetary structure, the monetary piping, and of course, everything centered around the Federal Reserve note, aka the dollar. And so we're going to talk about that and a lot more. But before I move forward, let's make sure everything is flowing smoothly. Let me know if you can hear me. Let me know if the visuals are coming in, and then we'll move forward. I have 8, 9, 10 tabs, couple graphics, lots of things that I'm going to try to condense into a short and detailed um, showing for today. So definitely looking forward to do that. And we're going to move forward, man. Man. It's just lots of things happening, lots of things brewing. And it's always something, man. But nevertheless, I'm very excited, man. Lots of exciting things going on. And yeah, God is good, man. God is good. Okay, it's going to be a good one. So I'm going to go through the typical format, give you some interesting things here, go through some market activity. Then I'm going to jump into the primary nuts and bolts of what I'm going to get at. And yesterday, I wanted to connect because I had a particular topic centered around reserve management, which is the new rebranded form of quantitative easing, and a trend that I'm noticing, which clearly ties into what I want to talk about today in reference to the halting of investors' funds. And so it's one of the things where if everybody rushes to the exit at the same time, they're going to lock the doors. And that's what we're beginning to see. And we just got one of what I believe could be many more to come of investment firms that are literally being drawn upon because investors are either experiencing a tightness in their financial structure, personal finances, business structures, or they want capital to get out of harm's way, or they want to put it into something safe, true, tried, and tested. And of course, you know what that is. So different narratives, different stories, but then again, you connect all these pieces of the puzzle, it creates a very concerning picture of which I'm sure you're more than aware of, but I'm going to give it to you in a different way that you might have heard anywhere else. But okay. But before I move forward, so once again, just trying things on my end, flipping things up, trying to create some more energy for myself. And as you can see on the screen here, that's what I'm attempting to do here. So I want to just give it to you straight. And before I move forward, for those who may not be familiar, coming from the good old Detroit, Michigan. And so as of right now, as you can see, the weather's turning a little bit. We got 34 degrees with the possibility of hitting 49 with some sun today. So that's going to be definitely a good thing. And let's jump into it. So for those who might not be familiar, I want to encourage you, if you haven't, to test your silver IQ. 15 quick questions make a world of difference to open up your brains towards monetary literacy, as I like to call it. And as of now, average score isn't too good, which lets me know that I have more work to do as far as helping people understand the historical aspects of their what they call money. So definitely links in the description. Check it out if you guys want to. And we're going to go forward. But I put together an infographic, as you can see here. You really can't see the details of it, but I want to go deeper into it. But this is just a synopsis of the primary story we're going to talk about here. And it has everything to do with the liquidity crunch in the private sector and the potential risk that could spill over into a $3 trillion market. So that I'm sure you're going to want to pay attention to. So we're going to touch on that and a lot more. But before I do that, let's just jump into some things that I believe are of importance to you. And so it has everything to do with precious metals. And so let's just jump into it. So on the screen here, you can see this is what we're looking at right now. I've noticed for the last week, since we had the initial drawdown out of nowhere midweek, was about a week ago, that we've been hovering around the 70 75 or so range, up and down from there. Haven't we touched 80, then came back down. So clearly that 75 to 80 is the range that the orchestrators of this experience were having, is trying to contain those numbers there. And of course, gold, touch 5,000 1 minute, then it drops below. But 75 to 5,000 is a ballpark range where we're in for now. But come March, it's all subject to change due to the COMEX and all the expectation for deliveries and the continual drawdown of the stockpile that isn't there. So be patient. Silver and gold, true, tried and tested. It was here before you're born. It's going to be here after you're gone. Believe me, it's going to do fine. So continue to do what you do. Stack, get heavy, enjoy life. Okay, that's just insurance on all the other things we're going through. But for the average Joe and Jane who's not paying attention, not aware, this is what we're going to get into today's topic, which has a lot to do with the credit side of things. So let's not waste any more time. Let me give it to you straight. So I was actually combing through the internet, and so came across this article here. But this is just, I guess, extra credit compared to what I was really going to talk about yesterday that I didn't get a chance to do it. It has everything to do with the reserve asset management, or the Federal Reserve's QE, not QE, that has been launched since the beginning of this year to the tune of 44 billion-ish, plus the continual tapping of the repo market, because there's obviously some stress on the financial side, probably with the bigger banks. Then you got the commercial real estate, which is just crashing right now. And you got residential real estate, which is also having problems in certain areas. So, we got we just so much, and it's all centered around debt. Future promises to pay that can't be realized unless the Federal Reserve cuts on that monetary spigot. And based upon the chart I'm going to show you in a minute, the spigot's on. It's just not enough. And this is the problem. It's the liquidity crunch, because there's not enough liquidity available to service all the promises that people are expected to be compensated for. But let's jump into this. It says Blue Owl sells 1.4 billion from 3 credit funds, permanently halts redemptions at one of the funds. And so when I saw the idea of permanently then halting, imagine being on the receiving end of what you were expecting to get back once you decided to log in to your account to try to, on the screen, you have a certain amount of currency that you invested into this firm. And so you put in a request to have it withdrawn, and you were told, it's going to be a while. Slow it down. We're having a run on our system to where we can't meet obligations fast enough. So therefore, we're going to put a little pause on this. So imagine the person that logged in trying to get out. You like, well, damn, I'm trying to get out for a reason, not just because I'm bored. I need the funds. So imagine the dominoes that will fall from that. And could Blue Owl be the first one? Yes, it's the first one that we know of. But of course, there's a lot more that you may or may not be hearing about, because the media has to control this narrative so that things don't get out of hand and people realize that there's a run on these credit funds here, plus some, because they don't want it to spill over to the banks, because all this we're experiencing is about protecting the banks. And speaking of banks, let me give you something else that you may or may not be aware of. Let me give you something else here. Let me just get this. So this is completely off topic, but I thought I would just share this because at the end of the day, as I mentioned, it's all about the banks. And the numero uno bank of all banks looks like they may be in the race to become, let me get it on the screen here. They may be in the race to become, as it says here, let me give it to you here. Oops, let me see. I gotta get myself together here. As it says here, JP Morgan in talks to bank for Trump's Board of Peace, FT says. So here you got a picture of JP Morgan with Donald Trump's little silhouette here. And JP Morgan is in a position to be considered the numero uno, to be the financier, the backing, and the savings pot for the Board of Peace for all the countries that are participating on this biblically prophetic peace deal that's being set up, which is nothing to do with peace. It's more so a private, off the books, amongst nation states and private entities gathering for the expansion of a different world order. Okay, but I'll leave it at that. I'll leave it at that. But that was just some extra because it has to do with banks, and J.P. Morgan is in position to be the biggest bank of all banks that they already are, plus some. So just a little something extra. Just a little something extra, man. You can't make this stuff up if you try. This is life. Okay, so let me give you some more stuff here. I got lots of stuff, man. But let me just stop and get back to the nitty gritty. Okay, so let me get back to the story here about Blue Owl, one of many. Okay, so what really sparked my interest on this one is that how it gives you synopsis of all the events, and then it's the commentary associated with this that I thought was worth highlighting, and then all the things I want to put on top of it. But let me zoom in so you can see what I see here. And so I will read through as briefly and give you some nuts and bolts. Actually, I'll just make it so that you can get more of it. So let me know if you guys can hear and see this, and then I want to make sure I give it to you straight. All right, so here, this is the same article. I just want to highlight and make it bigger if you can see. But just to give you an idea what's going on, private capital firm Blue Owl, whose shares have halved over the last year, is selling 1.4 billion assets from three of its credit funds so they can return capital to investors and pay down debt. So, pay down debt and return funds to capital, to return capital to investors is what is being highlighted here. It says permanently halting redemptions at one of the funds, the company said, as the direct lending and software stocks come under increasing pressure. So, exactly what are they talking about? This is what we're talking about right here. So, on the screen here, as you can see, we have continual pressure because the share price of Blue Owl is not doing too good. And this is the over the last year aspect. And basically, what has really happened over the last year? As you can see here, we've gone through a lot of things given this current administration and the tariff situation, trying to balance trade, the deficit situation, all those terms that this administration is hard pressed on making sure he solves. All it does is shakes up and it just re reorganizes all the back end things centered around our national currency and how the monetary piping associated with debt now functions. And so the US has become so great because we've been able to export debt and intake real goods. But now nations don't need our debt. We've had the margin calls that have really further tightened up the desire for for currency to flow freely, and the Federal Reserve is not providing ample enough liquidity as needed. And I assume and believe this has a lot to do with this current restructuring and reset that we're in the midst of. Has much, has not a lot to do with the whole, Jerome Powell and Trump beef, whatever. They want to make it seem like they're going against each other, but ultimately it's all debt centered. And so our government needs that just as well as the Federal Reserve needs to create that in order to keep this Ponzi scheme going. So they're still working towards a greater good of enslaving humanity through debt. But it's just the pace at which the debt or the spigot is not flowing fast enough. So it's impacting any and every company that has taken out large amounts of debt or received capital from institutions that have taken out debt, which is where this starts to come to a little bit of a problem. So their stock price is being drawn down severely because people are cashing out, realizing the signs of the times, and more people need liquidity now than they have before because they have obligations to meet. And so it's a daisy chain of events of everybody needing liquidity. And so these companies like this, private equity firms, which were created as a result of all the regulation that has been placed and opened up to where they have been able to create all types of products and financialize every aspect of our lives as investment vehicles for the uber wealthy. But now that's all coming to a transition. So this is just one of many other companies. Every private equity firm over the last, all the big boys are experiencing drawdown. So this is just not a Blue Owl thing. And what do I mean? If I take you to another article here is another look at these private equity firms or alternative managing stocks. And so you got Blackstone, you got Blue Owl, you got Colbert, you got Apollo Global, you got the Morningstar US Market Index, Ares Management. So everybody is having some issues with their stocks here. So as I show you on the screen here, as you can see, everything is drawn down over the last year. And so it's picked up over the last several weeks for all of these companies here and indexes that track the valuation of these companies. So everybody's in the negative now. And clearly, this will impact the overall $3 trillion private equity market in general. And so the Fed knows this. They're keeping an eye on this. And you better believe when it's time, they'll step in at the right time after something breaks. And so, literally, we can go with this prolonged, I would say, prolonged, just stalled, stale, plateaued of an economy until something happens with the too big to fail banks. As long as they're doing fine, or they're above surface appearing to do fine, they can keep on with these charades for quite some time, because it's the stuff under the surface, such as private equity and everything else, that they can let them go under, as long as it doesn't fall into the too big to fail banks, because that's what this is all about, protecting at the end of the day. Okay, so let me get back to my primary story here. So in reading this initial article here, what I got down to some of the details of it, on top of other things here, it was some commentary by economist Mohammed El Iran, who's a contributor on all the major, primarily Fox News or whatever. And it's his comments here is what I want to focus on, because this is the part where you can't ignore this. So it says, economist Mohammed El Iran said the changes at Blue Owl echo the early days of the 2008 financial crisis. And then it gives you some much better quote. It says, is this the canary in the coal mine moment similar to August 2007? Elron wrote on X on Thursday. The question will be on the minds of some investors and policymakers this morning as they assess the news that Blue Owl is halting redemptions. And so, with that statement there, that is what led me to really begin to question, okay, we have a major, well-respected economist bringing a question, is this that 2000 GFC canary in the coal mine? Is this possibly the spark that lit the bigger contagion that's coming? And the answer is, it's one of many, in my opinion. And so, as I just mentioned before, one of many, and given the fact that we have other companies that are in the same boat, it's just that Blue Owl is the first to outright admit to concerns and the pace of withdrawals to where they were forced to halt redemptions. And then this gets me into the next thing I want to touch on, which is the infographic that I put together that kind of paints a picture of what this looks like. And so what I'm going to do is just zoom in here and give you the nuts and bolts. So literally what we're witnessing, as you can see here, liquidity crunch in the private credit market, and it's a $3 trillion market. Just let that sit in, $3 trillion market. And so you got the first fund freeze, Blue Owl Capital halts redemptions. And so investors withdrawals, the OBDC II, 1.7 billion private credit fund is what they decided to withdraw back. And they have 307 billion under management. So that 1.7 is peanuts. But all it takes is rumors or whispers of people looking to exit, and they're being told no before it brings into question everybody else's in their coffers. And so that $307 billion definitely not liquid. It's definitely not liquid. They can't just call up and just retake back everything that they have invested throughout a multitude of sectors. So that's going to make a lot of people question and wonder. And then you got the fact here, a lot of the things they're invested in is illiquid, meaning that you just can't call up and say, hey, we are having some issues. We need some funds back. So let me go ahead and get that, 20 billion up off you. No, because they're tied into things that just can't move without impacting the markets, i.e. commercial real estate. Can anybody say commercial real estate? And or other sectors that are definitely not stuff that you can sell overnight. So once again, the funds are locked in. So it's good to say that 307 that's under their management, it's probably also locked up. So therefore, panic might ensue. And so here it says here, warning signs in the private credit. And so this is what we're looking at. As you can see, a negative cash flow. They are experiencing more liabilities than they are revenue. So literally the 40% to direct lenders, they're starting to lose a little bit. And their refinancing risk, it says 30% of the debt by 2027 is already in the negative. So what's coming due next year, they're already experiencing some concerns with that because you lend out, but you may not be able to get back what you lent out because of the distress in other industries that are experiencing issues. And then you got the rising default risk. And then you have, as it says here, the 4.55% default rate is climbing, meaning that the daisy chain effect of other industries being impacted by the companies that own and are have received funds from Blue Owl, they may not be getting paid either to be able to service the debts that they owe to Blue Owl. And so, literally, it says here 7 quarters more of downgrades than upgrades. And so, a lot of these sectors here in the private sector, in the private credit market, are experiencing more drawdown than anything else. Okay, so just look in the middle here. It says tight credit leads to a liquidity squeeze, which leads to more defaults and then more redemption pressure. So this loop in the middle here is kind of what Blue Owl is in the midst of experiencing. Because of the current conditions we're in as a whole, it's putting liquidity pressures. There's not enough funds flowing around to meet demand to the pace that it's being requested, which creates defaults, which puts more redemption pressure. So Blue Owl will be one of many. Okay, so ultimately what will happen? They need some liquidity. So it's going to be either the Fed cuts, lowering interest rates, making it easier to refinance a lot of this debt that's out here, and therefore providing easier refinancing opportunities, which can stabilize some of the defaults. So this is where it's in the Fed's hands now. What will the Fed do? And then you have the risk, rising defaults of things that you don't know about, things that we don't hear about happening behind the surface. They will continue to go higher and higher, which will then lead to, as it says at the very bottom here, an economic fallout, all associated with a $3 trillion private market. And so that is something that, that spiral in the middle will get worse and worse and worse unless the Fed steps in. So this leads to the next thing I want to talk about. So this was something I was going to talk about yesterday because once again, I was, today just, doing a little homework and I was looking at the Federal Reserve's market dashboard and just basically just looking at the rates and what the Federal Reserve's balance sheet looks like, what it's made up of. And so let me give you a synopsis here. So right here we have domestic holdings. So this is the Federal Reserve's, this is what they're holding right now in the form of debt instruments denominated in Federal Reserve note terms that the private sector and governments have on their balance sheet. And so as you can see here, $6.2 trillion. This is what their balance sheet looks like, and this is what it's made up of. But notice what's the largest on here to the tune of trillions. We have U.S. Treasury bonds, $3.5 trillion sitting there. And then you have agency mortgage-backed securities at $2 trillion. So that's $5.5 trillion right then and there on things that can't move. The Federal Reserve is the largest real estate owner in the world with $2 trillion worth of real estate on their balance sheet. And they're sitting in 3.5 trillion of notes and bonds that the world no longer requires. I mean, I say they still need it because everything is denominated in US dollar terms, so that's still liquidity. But once again, if the world don't buy them, who's stuck with them? The Federal Reserve. And so my whole point is this is a change from the prior week. So as of last week to this week, their balance sheet went up 16 billion And this is going to be a weekly occurrence. And this is just a small number. And this is the part of the liquidity crunch, liquidity squeeze. 16 billion is not enough to be put back into the coffers of private, government, and everybody else's banking accounts fast enough. So this is going to be more of the drawdown that's going to be a problem, because it's not until this number turns into, say, emergency type figures to the tune of, I'm looking at maybe high nine digits, close to like, 500+ billion dollars. I'll probably say monthly will we start to see some type of true easing. And so the 16 billion that came on the balance sheet last week is peanuts. And so this leads to what I wanted to touch on, which is here. Let me get this on the screen here. So as you can see here on the screen, this is what that 6.2 looks like. And so we are right here. And let me just zoom in. So this is QT coming to an end. It came to an end on December 3rd. There's no more QT. We're in the QE phase, or let me share, the new term. Let me give you the term. Let me find my, no, let me just go back here. Let me go back. Nope, that's a different page. Okay, so this is the last, since December 3rd, QT ended, we're in the QE phase, or reserve management, as they're referring to it as, period. And let me see. Okay, so this is the reserve management period. So literally, that same time QT ended, December 3rd, they changed the name to Reserve Management Purchases. RMPs are a key component of the Federal Reserve current monetary policy framework designed to maintain an ample level of reserves in the banking system. And so this is what Jerome Powell got up on the stage and said. Mind you, this is all centered around, as it says here, maintain ample levels of reserves. Ample. What does ample mean? More than enough. Running together, shaking over with a Fed given to your bank accounts type funds. That's not ample. And that 3 trillion I just showed you a minute ago, it's all ledgers on the screen. It's debit and credit ledgers on the screen. There's nothing there. And so how do you service something that's not there? You create more of it to make it look like you're adding to it. So we're going to need a lot more ample, but that's what reserve management is about. So I showed you that so I can tell you, or show you what that reserve management. So December 3rd is when it became reserve management. And so they're saying that they're responsible for providing ample. And so here's the problem. This is supposed to be ample. On the screen, let me zoom in here. So this is supposed to be ample. So QT stopped, and since then, this is supposed to be ample. And as you can see here, on December 31st, we went from 6.53 to 6.64. So that was over $100 billion. And then we came down. And so now, since January 14th, as you can see on the screen, they are providing some, but not ample, in comparison to what's needed. So as of right now, this is the balance sheet, 6.62 I just showed you of what is out there. And this is where we at. This is where we're at as of last week. So as I said before, this is 6.2. In order to make it ample to help protect the private side, the globally systemic important banks, and everybody named Mother, we're going to need trillions. They're gonna have to make trillions. And right now, this is not enough, but it's going up. Point is, the liquidity drain is being serviced, but not fast enough or nowhere near enough that the total debt world needs. So we got a long way to go. And as a result of all this, we know it's coming because it's here now. This is reserve management, aka QE now. But 6.2 is peanuts compared to what it was during the peak of the crisis, which happened during the health situation where it got up to almost 9 trillion. They got it from almost say, just say 9 trillion down to 6. That was 3 trillion they let roll off, come due, they pay it off and let it poof. So now when stuff hits the fan for the globally systemic important banks, which it will come at some point, we're going to go past 9 trillion. We're going to go to 15 trillion, to 16 trillion, to 20 trillion. There's no ceiling to how high this balance sheet going to go, because once again, when it's disguised as protecting the Federal Reserve note or the dollar, they're going to let that boy rip. Okay, and this gets to the next point. This is what we've been witnessing over the last not even almost a year. This emergency, this is emergency territory where you have the overnight repurchase agreements, meaning you got the banks or the holders of these liabilities. They're in need of liquidity, so they literally overnight they send on the screen billions of dollars worth of bonds and treasuries to the Fed, and the Fed sends them cash. And as you can see here, we're seeing systemic levels. So let me just zoom out. So on the screen here, you can see that this is what, whenever there's a crisis, these blue lines, these dark blue only appear when there's liquidity issues in the system. We got it before the GFC, big gray bar, and then we got it to historical levels during the health situation, September 2019, to be exact. We all know what happened. I've been talking about it for years now. And we got the big gray bars. And so notice this. Whenever there's a gray bar, meaning a recession, the dark blue, which is the support for the banks, comes to an end because something new was created. So this blue line disappeared the moment they announced quantitative easing. So we had QE1, QE2, QE3 all up in here. Here we had 2019, in September 2019, behind the scenes, due to the tightening of the rates, banks underwater, big gray bar comes, or short gray bar comes, the blue line disappears. Then they introduce two or three new lending windows. I forgot the name off the top of my head. But the lending windows that they created during this time period, those disappeared. And then the dark blue showed up again where we're at now. And so what does that mean? That means that there's another crisis here. There should be a gray bar officially coming soon. When that gray bar shows up on the screen, that's when they'll introduce some other type of emergency metric vehicle to bail out the too big to fail banks. But this is what we're witnessing. So we got what looks like the fourth or so biggest draw upon the emergency lending window for liquidity. And only people got access is the big boys, the G-SIBs. And so I say all that because ultimately what it looks like is we're having a situation where private credit is more than likely impacting the G-SIB, globally systemic important banks, to some magnitude, to where the drawdown starts from the small boys, working its way up to the big boys, and the big boys is deciding to tap the emergency window here to try to get some liquidity so that they can make sure that they are covered. Because everything, the daisy chain starts with the private sector, small boys, mom and pop's businesses, onto the manufacturers, distributors, onto the private credit that speculates and gambles. Then you got onto the big boys. So that once it hits the G-SIBs, you tap this, you get some relief overnight. But once again, it's not enough to really, really make a difference. And this is why I know the reserve management, that QE, what they're calling it, is just beginning, and there's more to come. And so what does that mean? There will be trillions of dollars created, and it will go directly towards people experiencing fear and panic. And well before then, all the bullion banks that are manipulating the price right now, keeping it between those ranges I talked about, they're actually withdrawing. They're getting tonnage. They loading up because they know when it's all said and done, real tier one capital happens to be tied into these two things here. And so they're going to be sitting heavy in their vaults, and all the credit stuff, all the promises of pay, and all the digital screen stuff that are One person's assets, another person's liability, it's going to be like just like that. Just like it came into existence, it's going to be gone. Then we'll start over and restructure, reset. Everybody who lost everything associated with counterparty risk will be wiped out. Then it'll be easier to come in and say, hey, we got a solution. Download this, get this digital credit here, make sure your digital ID is connected, yada, 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 yada. Life goes on. Now, with a new world order, they control everything the way they always have. And voila, we live happily ever after. Or, as the World Economic Forum say it, you'll own nothing, but you'll be happy. Imagine that. Imagine that being your motto. How bad will it get on the streets to where you will own nothing and be happy with that? That means complete desperation, destitute. You'll be grateful for whatever your slave master, aka your government, will give you. That's kind of how I read that as. I could be wrong, but then again, been doing this for quite some time, and I kind of feel like I'm usually on point with things. But that's just my 2 cents. I could be 100% wrong, but that's my story. I'm gonna stick with it. And like none of this is like make me feel good type information. But then again, this is what they're working towards on the back end. This is what all this is centered about. This Federal Reserve note here, this is what it's all centered around. Keeping the system intact for the people who run it so that they can profit at the expense of everybody else. That's what it usually boils down to. Okay. So let me give you a couple other things here I bookmarked. Just want to give you all this unfortunate news. Here's something worth being reminded of. On the screen here, we have silver markets expected to run 6 straight supply deficit this year. So that means no matter how much of the funny currency or the promises to pay that will be reneged upon takes place, we still are experiencing a supply deficit of silver, which is the first and most important monetary medium of all times. So therefore, holding a single ounce in a world of digital and paper distractions will serve you better than anything else that you may or may not be able to get a hold of when you think you can. So continue to do what you can, because right now with silver being $78.72 at the time of this recording, it is the cheapest thing that you can buy that has historical monetary medium / everything else in between type of properties that can protect you and your future generations, in my opinion, just from a financial standpoint. Okay. But this is just an interesting headline here. Here's another one that might be worth your time. Gold is hitting a point where insurers are having problems insuring it because of the cost on their end and the likelihood that they don't have enough capital to insure it. Soaring gold prices forces vaults to reduce insurance coverage. So literally, you got vaults that are stocking up on gold and silver right now to the tune of high billions, and they've reached their cap as to how much they'll be willing to or how much they can get insurance on their vaults. What's in there in fiat terms. And so once again, most of these major just vault holding companies and like metals places to sell bullion, they're going to end up using the metal in of itself to secure itself. Meaning that at some point, if you can't get insurance coverage, you have to become your own insurer. Only problem with that is if it's stolen, vaults broken into, you only covered up to that amount that you have insured, which might be $1 billion worth of gold. But anything above that $1 billion threshold, you take the loss of. So over time, as the value in fiat terms of gold and silver goes up, ensuring it will become more costlier, if not impossible, to where gold and silver will be reinstituted as a complete monetary medium, in the sense that not only is it an absorber of fiat currency, but it also is a shield against the destruction of the fiat currency, making it like, insurance on top of insurance, as long as those chemical elements remain in your possession. This is on the institutional level. So imagine going down to the mom and pop side of things of just having 1 ounce is insurance against a diminishment of purchasing power from your currency, but then that 1 ounce in your hand insures you against any and everything else as far as providing you liquidity if you needed it. Emergency sakes, to emergency fund. You want to buy an acre of land at some point in the future. 1 ounce of silver might do that. That's just my 2 cents. I could be wrong, but once again, just some hypothetical things worth considering. And what else I got here? I got lots of interesting things here, but nothing really like I got through the main gist of what I wanted to touch on. And so with that being the case, everything that I wanted to get out, I got out. Hope it makes sense. The liquidity crunch is real. Liquidity is here, but not enough. So therefore, expect more volatility, more defaults, more freezes on redemptions in a variety of things. And then once something happens with the G-SIBs, JP Morgan, Goldman Sachs, any of those big boys, then they're going to cut the spigot on, create trillions, disguise it, of course, as some type of event that took place with a foreign country or some bad actor. It's going to be a bad actor, whatever those are, because really it's going to be just a monetary debt phenomenon that, once again, it's no way of solving it with the same level of problems or thinking that got us into this. So there's going to be some type of excuse. But once again, you know what's going on. You know what's happening. Continue to do what you do. Love, live, laugh, learn, stack. And definitely share your faith with somebody else, because at the end of the day, none of this was really important when it comes down to the most important asset in humanity, which is the human soul. And for me, as a believer in Christ, it's my responsibility to continue to remind people the importance of spreading the good news, sowing seeds daily, investing in the eternal kingdom, so that your reward, when he comes, will be given to you. It's going to be something that you would rather have than any of this little stuff that just, keeps you preoccupied in the meantime, in the natural. That's just my 2 cents. But once again, making sure I try to encourage you spiritually. If you were encouraged, as always, hit that thumbs up button. Show some love for your boy. It's been a minute, but if you haven't, definitely hit that thumbs up button, and feel free to share thoughts, ideas, suggestions, anything that comes to mind. Definitely drop a comment, take this, share it, give an alternative perspective to your family, friends, and be a blessing. Other than that, love, live, laugh, learn. And I will